First and foremost, I hope everyone's doing okay during these most challenging and unprecedented times. Good afternoon, my name is Michael Rosen, and I lead the capital markets engagement efforts here at CECP CEO Investor Forum. I am both thrilled and honored to welcome you to the launch of the CEO Investor Forum Network. Before we begin, I'd like to acknowledge the first three founding members of the new CEO Investor Forum Network. American Electric as one of the largest electric companies in the United States. Aptiv, the global technology firm enabling the future of mobility. And KPMG, the multinational professional services firm. These three companies have demonstrated their leadership in the forward-looking disclosure space. Now, as some of you may know, the CEO Investor Forum, formerly known as the Strategic Investor Initiative, was founded 3 years ago following CECP's Board of Boards, where 86% of CEOs admitted to yielding to the short-term pressures of the capital markets, despite their acknowledgement that the short-term decisions would likely hinder long-term value creation. Since then, through our proprietary research-driven, market-tested tools, resources, and advisory services, the CEO Investor Forum team has helped over 30 of the world's leading companies prepare and communicate their long-term value creation plan. And as a result, refocus investor expectations from short-term earnings to long-term value creation. Now, we have a great discussion planned for you today, but before we dive in, I'd like to set the context for the discussion today, starting with these realities for both the corporate issuer community and the institutional investor community, followed by 2 polls. So on this screen, as you can see here, this really represents the reality for the corporate community. It's really all about the rise of stakeholder capitalism. This is probably take place in time, but I think probably one of the enormous really kind of advancing this moving forward was the Business Roundtable statement on revised purpose of a corporation back in August of 19. But coming into 2020, momentum has continued to build, and as I like to say, hockey stick up and to the right. As you think about at Davos, the World Economic Forum, big discussion on May State, something that had been really getting to the side of the event in prior years. You have SASB and TCFD becoming a very important part of market infrastructure with the likes of, I think, writing that letter back in January, and Ray will be able to comment on that. But then we also have the global pandemic that we're all struggling with right now. Companies really thinking about how they're managing business and as well as taking care of their employees and other key stakeholders. You also have the social justice movement that continues to just gain momentum. And you also have the SEC even beginning to weigh in on asking companies to provide long-term forward-looking communication to the key stakeholders. So that leaves issuers with the question, well, so where do we go from here? And so on the right-hand side of the slide, you can see a lot of the questions that companies have been asking us at the CEO Investor Forum over the past couple of months as we prepared for this launch today. What are the market expectations in this new era of capitalism? What's the role of ESG in investor decision-making? Of the 100 reporting frameworks that are out there, what's most relevant, which I'm spending my time? And what are the most relevant ESG ratings and research providers? And should I be managing my business to juice my rating or score as it relates to those providers? So that's the landscape as you think about from the issuer's perspective. Let's go to the other side and talk about the institutional investor perspective, right? Here at the center. As you can see, all these arrows here are really talking about information that's coming into the institutional investor. And the key point here is that there's 2 pieces. One that the issuer, right, can influence, and the other that really doesn't have too much power, I would say, to influence. So on the left-hand side of this chart, we think about the important part of the market infrastructure being the ESG ratings providers, and they provide a very important role, right, in the ecosystem. But there was this seminal study that Professor Rigobon from MIT, as well as some of his fellow researchers, came up with a few years ago. They really sought to interrogate how it's possible that different providers can be looking at the same information, right, but coming up with vastly different assessments on how the company performs from an ESG ratings perspective. And as you can see on the back of this chart, that map there is really just the correlation chart within the aggregate confusion study. And the idea here, the finding was that it's a lot of the proprietary work that the ratings provider does that's unfortunately not public to the issuer community. As a result, there's not much you can do to influence that, right, to juice your rating. Compare that with the other side, right? You as Mr. and Mrs. Corporate Issuer. The reality, and it's changing, and we'll see what happens in this poll that we'll have right after this, but institutional investors are going to go wherever they can to get the information that they seek. And historically, and we're starting to see this change, different departments have operated in silos and haven't really shared information and had that internal alignment, which is critical. And we think that's a key piece of really structuring a cohesive, consistent, forward-looking, and I'm going to come back to forward-looking because that is what we are doing here at the CEO Investor Forum, consistent, forward-looking ESG and sustainability message to institutional investors. This slide right here, and this is my last one, really kind of sets the stage for the landscape of the existing market infrastructure as it relates to ESG and sustainability. On the left-hand side of the screen, you can see the three pillars that are key parts of the market infrastructure, right? So on the first column, you have the ESG ratings providers, right, discussed on the previous slide. You have the ESG standards and policy setters, think SASB, TCFD, GRI. And then you also have the ESG reporting guidance frameworks, both sector agnostic, right? So you think about the SDGs, for example, as well as the sector-aligned guidance, right? From organizations like the Biopharma Sustainability Roundtable or Edison Electric Institute, right? These are all core parts of the infrastructure. The challenge here, though, is most of the information that comes from this is backward-looking. By definition, reporting is backward-looking. And so it's helpful, but up until a point, because as the market is a discounting mechanism of future cash flows, investors want to hear how you're going to manage your business going forward over the long term. And that's exactly the place that the CEO Investor Forum is helping companies to really reorient the time frame, right, of expectations from short-term earnings, and that's important, but really talking that in the context of the long-term value creation strategy. And so we've developed a long-term plan framework in partnership with institutional investors, and really it's an innovation community that really empowers CEOs to do just this by answering asking questions along 9 key themes and 22 sub-themes, right, about the forward-looking nature of what information investors are looking to help de-risk their investment thesis on the long-term prospects of your company. And so again, how does this drive the narrative? It provides forward-looking signals from your IR program to investors. And is it a decision useful? Absolutely, because it helps investors understand how the company plans to manage the business over the next 3 to 5, and then depending on industry and capital planning cycles, 7 years out. And it does use some of the existing market infrastructure on the left side, but really to talk about the forward-looking elements of it. So with that being the context, maybe let's go to our first poll question.
Michael, just before we get there, there has been some audio challenges on your end. I think there's been some sounds breaking up. I wonder if for the rest of the conversation, maybe, do you think it might be safe to dial in on your phone and use that as a backup?
Sure. So Nandika, do you want to take the polls while I dial in?
Sure. All right, here's your first one. Has your corporate citizenship department or similar department been called upon to provide environmental, social, and/or governance information to a particular investor or to the investor relations department? Please choose one or more. I don't know. And Jess, you'll let us know as we get the results coming in?
Yes, ma'am.
Thank you. How are we doing?
Yeah, let's give it a few more seconds. We have about half of everybody voting, so try to get that polling in if you can.
All right. Wow, that is interesting. Yes to both a particular investor and investor relations department. And I will say that does tally with my own personal experience being on the corporate responsibility side of the house for a number of years, both at Citi and MetLife. So thank you for that. Michael, okay, here's another one. Does your company have a cross-functional ESG committee that meets throughout the year? No, yes annual, yes quarterly, yes monthly. Yes, monthly would be great. We should have had some music. Oh, interesting. 53% say no. And that definitely is a huge opportunity, which we will be talking a lot more about over the next 45 minutes or so. So thank you for doing that. And over to you, Michael. Unmute. Can't hear you. Yeah.
Can everyone hear me? Okay, great. So apologies for that. We have a great panel for you today with panelists representing the corporate issuer community, the institutional investor community, and the professional service community. So first, I'd like to introduce our panelists. First, Ray Cameron, who leads BlackRock's Investment Stewardship team for the Americas. In this role, Ray directly engages with issuers on the corporate governance practices that support sustainable financial performance over the long term. Ray is also a member of the CEO Investor Forum Advisory Board. Next, we have Stephen Brown, Senior Advisor at KPMG's Board Leadership Center. In this role, Stephen provides boards and business leaders with insights into the range of challenges and opportunities shaping the boardroom agenda. Stephen is also a member of the CEO Investor Forum Advisory Board. And to round out the discussion for today, I'm thrilled to welcome Nandika Madgavkar, who leads the new CEO Investor Forum. As many of you know, Nandika is a corporate social responsibility alum of Citi and MetLife, bringing her deep knowledge and expertise in responsible business to our organization. Now, I've prepared a series of questions for the panelists today to get us started, but please feel free to submit your questions in the chat box, and we'll do our best to address the questions in the time we have together. So with that, let's get started. Stephen, first questions to you.
Sure.
Everyone is acutely aware of how the COVID-19 global pandemic has driven the global economy into a recession. Overt racism has reared its ugly head once again, albeit this time encountered by a societal response strikingly different than in recent years. In the words of the late civil rights leader and conscious of Congress a month before he passed, Congressman John Lewis observed, "This feels and looks so different. It is so much more massive and all-inclusive." Now, as we think about confronting these two crises against the backdrop of the ongoing climate emergency that continues to pose the existential threat to the world as we know it, two questions. And so the first one is, what are some of the trends that you're seeing emerge from this perfect storm of events for the first 8 months of 2020, particularly those related to the boardroom and corporate governance?
Well, thank you for inviting me, everyone, and Michael. That question was not in it. But generally what we're seeing is that, first of all, ESG trends have been around in the United States for quite some time, let's say in the last 15 years, and it was growing. You use that hockey stick analogy. And then the pandemic happened, and then it died for about 48 hours, right? And everyone said, okay, back burner. And then very quickly realized, either they were told to realize by Ray and others, or they just understood it, that this was what has now been a prominent word in our lexicon. A lot of prominent words have popped up in 2020. And one word is essential. ESG is essential to your long-term viability. And so everyone, and we've seen it in our work, small and large, on that spectrum of where they are on the ESG journey. Journey is another one of those 2020 words that has reemerged. That has popped up, because part of that is one, health and safety, and that's primary. That came up in the pandemic. the health and safety of your customers and employees were job number one. And once you got through that, then was your long-term viability from a financing and cash flow issue. Where are you going to stay alive? And here we are 6 or 7 months afterwards, we pretty know the answer. And some people have not stayed alive, unfortunately. Now it's trying to really think through, what does ESG mean to me as a company? And I'm happy that the community has around the CEO Investment Forum and CECP to help them work through this information. Because the number thing that, and I'll end with this, that has really emerged as a trend is that people are overwhelmed. Beyond everything that they may be overwhelmed with, working from home, coming back into the office, the fiscal crisis, there's a lot in ESG, and it means so many different things to different people. And there are a number of different standards out there that there's a great deal of, quite frankly, anxiety. And it's hard to use that word anxiety in a period where a lot of people have a real medical anxiety. But it is this sort of a corporate, if you will, anxiety that people are feeling, that there's so much out there. We know we got to do something, and everyone's on a different page, which is why I think organizations like yourself around that, who are here to help folks work through that journey.
That's great. And then I guess, kind of as a follow on that, based on your conversations with KPMG clients, what's your sense, how well prepared are companies? I know you alluded to a little bit, but if you could just talk through a little bit more of that.
That last part was how well, and then you cut off a little.
How well prepared do you, are companies in your view?
Quite frankly, that's an easy question. There is a spectrum.
Mm.
And this was, I'm not shocked anymore, but I was shocked in the beginning that even some of your larger companies were still sort of emerging from the cave, and I try to put that in a good way. But there is a range. There is an absolute range of how companies are prepared. And, one of the things that I say about this pandemic and in the United States, the social unrest that we've had, that there is a chance to reset that button, right? And just like if you were an undeveloped company trying to put telephony into your system, you wouldn't lay landlines like we did, 150 years ago. You go right to, digital telephony. And same thing here. If you don't have a lot of infrastructure around ESG, that is absolutely fine. You don't have to do a transformation. You can just start. And so there's a range that we've seen. It'll be interesting to hear what Ray has to say, but there's a range. That's the news. I wouldn't say it's good or bad. The good news is that you can really start from the beginning quickly.
That's great. That's great. Nandika, maybe we'll go to you now. So in 2019, the E seemed to dominate the conversation around ESG. But based on the two crises that we identified in 2020 earlier, the S seems to have closed the gap, with some calling 2020 the year of the S. So as a former CSR practitioner at Citi and MetLife, my sense is that you and your CSR peers have always known this to be the case. So I'm curious to understand how can CSR teams position themselves as subject matter experts on the S, right, communicating to their CEO, CFO, IRO on the importance of integrating that company's social strategy across the lines of business, as well as external stakeholders.
Yeah. So, how can 2020 not be the year of the S? Companies have been under growing pressure to play a leadership role, especially in the sort of social and economic transformation that is taking place around us in real time. Corporate social investments have been the backbone of a company's presence and, quite honestly, their license to operate in communities over the years. And as a long-standing practitioner, I have historically have seen corporate responsibility, which has been defined as the S, sit within either corporate affairs, marketing and communications, and or the foundation, with little or no interaction with lines of business. However, over the last 5 to 7 years, there has been a groundswell and an increasing demand from institutional investors who are looking to invest in companies that drive sustainable value and effectively communicate that how are they going to manage material ESG risks across their lines of business. So with that said, this shift that has come around in the last few years has brought an internal realization, and it is leading to a breakdown of silos within companies, wherein the CEO, the CFO, the IRO, who have traditionally not really engaged with social investments, are now looking to CSR leaders to be that glue that brings together this trifecta of data to effectively communicate to the markets that they are indeed and have been, or let's say at least at their heart, they have been trying to do the right thing and be responsible corporate citizens. And corporate responsibility has traditionally been the gatekeeper and the owner of this social investment data, and the central body responsible for producing in most cases, the annual sustainability, the corporate responsibility, or the integrated report, depending on the maturity of the company. So this position, I believe, is centered to not only how a company invests in its employees, but also in its communities. And this has elevated the role of CSR, particularly now, to a preeminent position as senior leaders grapple to figure out issues of worker well-being, as Stephen mentioned, equity, and social justice issues. These are really issues that are rising to the top of the pile of concerns that keep CEOs awake at night. So CSR leaders, in my opinion, should really be doubling down on their efforts to take advantage of this tremendous shift from stakeholder capitalism from shareholder primacy, to stakeholder capitalism. And they should do so by consistently reporting, measuring, and communicating their long-term material sustainability factors. And it's as easy, and I say that with a little bit of a smile, as incorporating your ESG report out into your quarterly earnings call. Our head of research at the CEO Investor Forum, Brian Tomlinson, recently published a seminal paper, ESG in the earnings call, wherein he provides best practices on how companies, corporate responsibility, and senior leaders in the C-suite can actually operationalize this. And it's a simple first step, but it's the first step in the right direction. You can find that resource on our website. We post it in the chat, but do take a look and let us know what you think. And just to end on this, corporate leaders, this is your time, and the work you do within the company will be the test on how we as a society respond to the current crisis, because it's not going to be business as usual anymore. And so no pressure, but we are here to help. I hope that answers the question.
Yes, thanks, Nandika. Maybe, Ray, let's go to you. So BlackRock is likely a shareholder of every company participating in this webinar today. However, depending on which part of BlackRock owns the company, the interactions and engagement channels with the company will likely be different. So before we dive into the question, I think it'd be helpful to provide some context around you and team-specific role, mandate at BlackRock, and how you work with your investment professionals, in the decision-making process.
Okay, well, thank you, Michael, and thank you for the opportunity to represent BlackRock today, and thank you for all of the folks who have dialed in. I know that it's a very busy time as we're kicking off September, so we certainly appreciate your interest in this topic today. I'm here to represent BlackRock. I run the investment stewardship practice for the Americas. BlackRock is, one of the largest asset managers in the world. We understand that we are asset managers, not asset owners. We are representing our clients in terms of, their long-term financial objectives, typically, spanning a horizon of a couple of decades or so. So we're really looking at things through a longer-term lens. Of the, plus 7 trillion assets that we have under management, half on a global basis, half of that is in equities and half of it is in fixed income. But the half that's in equities, half of that or 90% of that half, I should say, is actually in index-oriented funds. And those are the assets that I represent. So we use our voice to encourage companies to make decisions through a longer-term lens that could have financial impact over time and lead to sustainability and resilience. One of the things that I like to say is that inform people of that we are part of the investment function within BlackRock. The team we provide, or we act as a bridge to various portfolio management groups and aim to deliver meaningful value to our clients through a range of activities. Those activities include the evaluation of governance at companies in our portfolio, engagement and relationship management with those companies, proxy voting, market updates, client reporting, and also engaging in public policy debate. One of the things that I'd like to highlight is that we work very closely with other parts of the organization. I'll talk about that in a little bit more detail, and I think it'll get to the question of how we engage with the active side of the equation. One of the things that I would underscore is that as the index side of the organization, we don't have the option of basically selling our ownership position where we have a footprint or a stake. We don't control the indices, and so as we're replicating those indices, if a company is represented in them, then we will have an ownership position. Often when you see a 3 to 5% position or higher in a company, the majority of that is represented through the investment stewardship side of the organization. In terms of scope, just to put some numbers around things, these are just some broad figures. They are not representative of the NPX filing that we just did. We'll update these numbers, but those numbers will get greater visibility, so to speak, in a couple of weeks when we'll release our annual report. But in the voting season ending in 2019, and again, I caveat that, we voted at over 16,000 shareholder meetings on approximately 150,000 proposals. And according to a third-party independent agency, all of those votes were cast in accordance with BlackRock's guidelines. In addition to that, we held over 2,500 engagements on a global basis, with over 40% of those occurring in the US. In addition to that, in terms of thought leadership, we participated in about 175 conferences and public events during that time period as well. So we try to be very visible in terms of providing education around how we think about governance. We operate in 7 offices globally. The team is plus 45 strong. We continue to add to the team. If you think about our geographical representation, it's about a third, a third, a third. And in the US and EMEA, we have sector responsibility for company coverage, which we think provides us more insight and allow us to pick up on some of those nuances, which inform how we vote during the voting season. I highlighted the fact that we engage very closely with the active portfolio managers and other parts of the organization. Some of you may recall in Larry's letter from 2020, where the focus was on sustainability. He characterized climate risk as investment risk. And part of that conversation also included more transparency on the part of the investment stewardship work that we do. And you see that evidenced in terms of a very white paper, if you will, around sustainability that we published just about a month ago. Increased transparency around our quarterly voting, and also we released vote bulletins during the voting season where we highlighted how we voted on a particular company around specific issues that may have been somewhat controversial. So I'll encourage you to take a look at some of that information that's actually up on our website. The other things that I would just highlight very quickly are that our 2 primary functions are engaging with companies, and that is where we have conversations with senior leaders of the organization. Increasingly, that's also represented by board members, particularly the lead or the chair or specific chairs of committees where it's relevant for us or important for us to have an engagement with them or to speak with them to ensure that they are, quite frankly, exercising their fiduciary responsibility. They are our voice in the boardroom, and so we want to make sure that they are embracing those responsibilities. When we engage with companies, it's typically around 5 engagement priorities, and they pull up into kind of the broad ESG framework, if you will. Board quality, where again we talk about board diversity and board effectiveness, environmental risk and opportunities, where obviously the focus there is not only just on climate risk, but also opportunities. Corporate strategy and capital allocation, where the focus there is on strategy, purpose, and also culture. Compensation that promotes long-termism, I think that speaks for itself. And then in this very broad bucket of human capital management, which we've spent some time talking about, and I'm happy to share some insights and reflections from our experience with companies around impact from COVID as well. But I think I'll leave my prepared comments there, and I'm happy to address any additional questions that you may have, Michael.
That's great. That's great. Maybe so that was really helpful from a as an investor perspective. But I think what some people might miss sometimes is that BlackRock is also a corporate issuer itself, right? And so I was wondering if you could share with us how your team fits and works with kind of BlackRock corporate across the broader corporate sustainability strategy, if any.
Okay, sure. So a couple of things. First of all, the investment stewardship that work that we do, though it's part of the investment functions of the organization, we are separate, right? So we cast votes based on the ownership that we represent in terms of the companies where we have a footprint. One of the things that's interesting is that we do leverage the expertise around the organization that is not only active side, where we have portfolio managers who've been at the firm for plus 20, 30 years and have deep insight into particular sectors or companies and can provide a lot of insight from a fundamental perspective, but also from the sustainability research arm, which they do a lot of work. One of the most recent pieces that they put out is on the importance of water and focusing on it as a sustainable resource. They also put out a piece a couple of months ago that looked at the returns for the first half, actually just a couple of weeks ago, they looked at the returns for the first half of the year for ESG-oriented funds, which it won't come as a surprise to most people on this call, in particular the panelists, that their performance has outperformed those funds that are not ESG-oriented. And so we think that that's very important. And the question that will, for a lot of people, is whether or not that is, quote, sustainable, and we believe that it is. And so the way that we engage with them is that we share information in terms of insights from the engagements that we do. We have a system that we use internally where we log our assessments to. It's kind of like a call report from a more traditional kind of brokerage firm perspective, a call report. And we share those insights when we have meetings with companies, and today it's mostly calls, as you can imagine, but in the past, it's been a fair number of in-person meetings, particularly in New York. We invite the active portfolio managers or the other sides of the organization to participate in those meetings as well. They bring a different lens. Increasingly, we are, sharing meetings. The difference is when it comes to voting. So while they may use the insight that we have in terms of an input into their investment decisions, ultimately how they decide to, retain a position in a company on the active side, or whether they decide to sell out of that, that's really their, at the end of the day, is their decision. During proxy voting season and in contentious situations, I think it's important to underscore that there's not a BlackRock house vote, right? Everyone's not required to vote the same. The active portfolio managers and some of those, for example, on the event-driven side, may have a different timeline in which they're looking at, and so that may inform how they decide to vote in a particular situation. So I think it's important to underscore that there's not a BlackRock Inc. vote. There's no committee that decides how we vote on during the voting season. The sector analysts on my team are the ones who have responsibility for actually casting votes. And so I think that's one of the differences that we bring to the table. We also have a proprietary rating system that we use internally that's used by BlackRock professionals and our global investment teams. And part of the work that we do is actually used as an input into that proprietary rating system. We don't advertise it publicly, but it is used. We also use the sustainability team also uses raw input from Sustainalytics and MSCI, and also source material from companies in terms of 10Ks, Qs, annual reports to inform the ratings that are put out. And about 3 years ago, BlackRock basically took the stance that an ESG lens would be incorporated into all investment decisions across all the teams across the organization. And the way that you can think about the work that we do is an input into that investment decision. For BlackRock Inc., we actually do an assessment, an engagement assessment on an annual basis of BlackRock Inc., according to using the engagement priorities as I highlighted, and we point out areas where there needs to be improvement, where there may be areas where they're lagging peers or opportunities for improvement, and so that's how we engage kind of across the organization.
So that's great. So just if I heard correctly, really not using the scoring or the actual ratings, but really using the underlying as an input to develop your own rating that you think is the competitive advantage to generate alpha, essentially. Is that right?
Yes,
great.
that's correct.
Super helpful. Thank you.
Sure.
Stephen, let's come back to you. So while it's unlikely that the E and the S will, or it is likely, I should say, that the E and the S will likely jockey back and forth depending on the events of the day, many thought leaders suggest that you can't have good E or good S without good G. So to that end, Stephen, over the summer, I know you argued in an article featured in the NACD Directorship magazine exactly this point, and there's an increasing expectation, right, of oversight of issues in the boardroom, and in that piece you identified specific focus areas for directors to meet these expectations. So I was hoping that you might be able to share that, because I think it's really important for different cross-functional leaders within an issuer to really understand the board role in developing and keeping track of the company's ESG strategy.
Well, Michael, I got about 70% of what you said. I'm sorry. But I believe that, so you referred to Directorship Magazine article. We're talking about board oversight of ESG and what boards should look at. And, I spend most of my time talking to boards, which is very interesting, because they have a different job than management, in that oversight. And by the way, as I remind board members all the time, people like Ray and his colleagues are the only people imbued by law to take away a director's job, right? Investors are the only people who have a vote. And so, pay attention to Ray and others is quite important. And sometimes that gets missed by management, right? Because management is not evaluated by investors, but directors are. Even though directors aren't responding to day-to-day operations. That said, you have oversight duties, and we know for years when you ask directors, whether it's Fortune 500, S&P 1000, you name it, they are top 10 lists, ESG found its way to sort of the bottom. It wasn't at the top. Whereas when you ask institutional investors the same question, ESG is at the top of their top 10 list. And so that imbalance between directors having it on the bottom of the top 10 and investors having on the top of their top 10, and investors being the people who evaluate directors, we saw this big disconnect. And that has been our focus for the last few years, because we just saw this gap, and that's been our focus to close that gap. One of the things that we tell directors is that take a deep breath and breathe in. This is a lot. But when you look at it as one of your oversight duties, just as you would look at accounting or look at the financial statements, you begin to understand that there are things that you've always cared about, but you look at it from a lens of risk, you look at it from a lens of opportunity, and you're able to deal with it. One of the biggest issues is that, we do tell this to boards, you got to make sure that your team is fit for purpose today. Meaning your folks in your human capital management functions may be excellent and maybe came up the ranks in human capital management, or HR, if you will, but may not have the skill sets for today. And that skill set for today are the things that we're thinking through as risks, and things that BlackRock and State Street and others people are thinking through in human capital management. You want to make sure that your staff is fit for purpose. Same thing on the governance side, the people who, corporate secretary, general counsel, those who are, and those in IR, investor relations, who are client facing or investor facing, if they have the right skills for today. And that's a tough conversation because sometimes they do. And Ray knows this because, and I did his job for a while at another asset manager. And now on the side of advising companies, now when I talk to boards and I sort of tell them about, you got to think about fit for purpose, they look at me and I said, listen, I sat across from your IR or corporate secretary years ago. I'm telling you nicely that, there's a gap there. And I try to say it nicely for them to focus on. But in general, boards, sort of thinking through these issues and trying to figure out where are the issues that are material to their long-term sustainable value creation. And we think there are probably 3 to 5. There are a lot of things out there, probably 3 to 5 that really drive that. and focus on those. And when you start to focus on that, you can get management to focus on those things. And then you're better able, a manager's better able to talk to people like investors such as BlackRock and others, and help them understand how you, company, think through ESG as it relates to long-term value creation.
Right. Michael, can I just ask a quick question of Stephen? Stephen, you know, one of the things that I've been struck by is that it seems that the board directors seem to kind of really get caught up in this ESG nomenclature. But the reality is, if you kind of peel it back, right, you're talking about management of people. You're talking about executive compensation that's aligned. You're talking about capital allocation. You're talking about really management of risk, how the board oversees that risk in terms of providing strategic, direction. It seems to me that some boards, some directors kind of use the nomenclature, quite frankly, as a way to kind of turn away from it. But the reality is, these risk assessments that they are supposed to be doing, that's embedded in ESG, aren't those the topics that the board is supposed to be talking about and dealing with anyway at the board level?
Absolutely. And, you know, again, there's a lot of psychology involved with all of this, and sort of dealing with people around ESG, dealing with the board. That's the first. And by the way, boards, average age 63, very skilled individuals. Many have been CEOs, so they've done a lot and they know a lot. And when you approach them with something which they have not done, a nomenclature they haven't talked about, the natural movement of a human being is to reject it, and also and politically to point fingers at we don't do that. You know, we buy low, sell high. We make money for our investors. And by the way, BlackRock says they want us to make money, of course. So there's a lot of that. But what we try to do is peel that back. And when you make issues relatable to what they've been thinking about all of their lives, and by the way, you've had this experience in talking to portfolio managers, when you ask them certain questions, like they care about it. But someone else can ask that same question, couch it a little bit different way, and it becomes either political or something social outside of the framework of how I think about my model in investment. And so part of this is being able to peel that away and say, these issues matter to you. Water, for instance, you mentioned water. My God, for a beverage company, you know, it is one of the most material issues. If you don't have access to water, you're not making Pepsi or Coke. You're just not. It's just, there's no other way to do it unless I haven't read something about how you can make a beverage without water. So it matters deeply. And so you're right, Ray. But part of this is peeling it back, and you've got to peel it back in order to get to the issues that they'll understand that they care about. But it's a process, and that is going on right now.
And can I just add to that, though, Stephen, because there was something in the Q&A which kind of builds a little bit on what Ray is saying, and I think it also relates to the fact that our boards tend to be fairly non-diverse, kind of as the person put it, like working off of outdated playbooks. And I think that's kind of an opportunity where a number of us, including KPMG, are kind of working on how do we bring the board along in many ways that currently they may not be that comfortable, right? So, I mean, to Ray's point, it is simplistic when you peel the onion, but then there is also this kind of legacy that some of these board members have that would make it perhaps not that comfortable for them, right? I mean, so bridging that gap, I think, is a challenge for us in 2021 and beyond, right?
Absolutely, and I've seen what you guys have been able to do in the process, and I'm gonna, from my standpoint as on the advisory board, simplify this greatly. A CEO comes to your CEO, Daryl, and says, "Okay, I agree. I'll do one of these presentations," and then he tells his management team, and they look at him like, "Okay." And there's quite some time where they try to figure out exactly what that is. And you guys sit there with your tremendous staff, the two of you on the call right now, Brian Tomlinson, who does terrific academic research, and you help folks through that process. You help them through that process of understanding, what you should be telling investors. And you do that not from theory. You do that because you've talked to Ray and his colleagues and the other major investors about what they want, and you've come up with what they want. And I know I've used that with clients, and I've been surprised. I said, look, there's 7 questions, and then I watch the presentation, and they don't answer any of them. And I go back and say, what happened?
Right.
What happened? Look, there's 7 questions you had to answer, and you didn't. And by
Simple.
the way, part of that, and I'll end with this, about how difficult it is. They're not used to talking in that way, right?
Yeah.
They're used to quarterly earnings call, which, if you will, it's a set standard, sort of harder information, and this stuff may be deemed as soft. It's very difficult. And so they pivot back to what they know. And part of this is that transformation where to say that it's okay. By the way, and you mentioned this, Michael, in the very beginning, this is forward-looking stuff as opposed to backwards, right? Reporting and finance, accounting, GAAP, backwards looking. This is forward-looking. It's hard to talk about it. And you guys are helping to develop that language and that comfort. And I'll say this, CEOs should make that commitment, say, we're going to do it. And then the staff will work with you, their CEO staff will work with you to help figure it out. And that's one of the great things about the CEO Investment Forum is that you were here to help them. Because after doing 30, I think 35 or 40 of these, you know where people need help. And these are 30 to 40 very senior companies.
Right.
Very, very senior companies. And so you have a great deal of experience in helping people work through this.
Yeah, thank you for that. Absolutely.
Yeah, thank you. That's great. So kind of to take that next step farther, because we're helping that, but it was interesting to see. I referenced the SEC and Chairman Clayton earlier, and perhaps I'm being a little naive, but I remember when I saw that press release come across the desk with Chairman Clayton and Director Hinman asking companies to put more forward-looking information out to stakeholders, including investors. And I just remember turning to my wife at the time, at home obviously, and just saying, oh my God, the SEC just effectively it was endorsing and encouraging, right, the corporate issuer community to do precisely what we've been doing and helping companies, for the past 3 years, and trying to put out more forward-looking long-term information to key stakeholders and institutional investors. And that's why I'm excited about the launch today. So Ray and Stephen, as advisory board members, wanted to see what your thoughts were when you saw that statement out by the SEC. Am I giving CECP too much credit? But then also more specifically, in the first 5 months, call it, since Chairman Clayton's guidance, we've been through 2 earnings seasons, right? With the next one about a month from now. And so I think we all agree that European investors are much more comfortable talking about this longer time horizon, right? And so my question is, than folks here in the US. So my question is, I'm wondering if you've noticed, at least in the first 2 earnings seasons, if you've seen an uptick in US companies starting to get more comfortable disclosing this more long-term ESG type information to the markets. And then also, if you have any thoughts about what we can expect as it relates to this upcoming earnings cycle.
Well, I'm happy to share my thoughts and perspectives in regarding Chairman Clayton. It's certainly progress, right? And it's something that we've been talking about from the BlackRock platform for a number of years, and that's the focus on long-term sustainability and resilience. And in fact, that was one of the reasons that Larry started writing his letters to CEOs 8 years ago. It was to encourage companies to really think through things and make decisions through a longer-term lens, and not just to be focused on the quarter-to-quarter results. And so I think that the work, the groundwork that that this organization has put in place, it's the right place, right time, and the visibility is there. But providing the templates and providing the visibility such that companies realize that they don't have to start from scratch, right? They can leverage the work that's already been done. There is foundational work that's already been done that they can tap into. And there are templates that are already, ready for them to basically kind of pull. I think that you're in a tremendous place. And so it couldn't come at a better time. And I think that the organization is incredibly well positioned. In terms of the question around the couple of earnings periods that we've seen, I'm not sure that we can actually infer a lot from these two earnings seasons, simply because the visibility, quite frankly, has been so poor by companies that they've actually pulled forward guidance, or they haven't given guidance at all. So I don't think that it's a good barometer, but I can tell you that I am somewhat encouraged by the conversations that we are having with companies during engagements, as we're talking about the impact of the pandemic, not only from initial response, but also, you know, in this recovery period. And this recovery phase, as I call it, the second phase, is more difficult for a lot of companies as they kind of think about this being a longer runway than they may have thought about being in this particular phase. And some of the early benefits from, you know, working from home, the productivity increases, et cetera, are starting to dissipate as we recognize that this new normal, or business as unusual as we call it, is kind of is going to be here for a while. So I think that, you know, based on the tenor of the conversations, there is some perspective around, you know, making decisions through a longer lens. But I think that the reality is there are a lot of companies, quite frankly, that are just focused on making sure that not only that they survive, as, you know, Stephen highlighted, some of the companies did not survive, but we're encouraging them as they are making these very difficult decisions to really think about the purpose, really think about the culture, what they've represented to the marketplace in the past. And that really should inform how they go about making the decisions, these difficult decisions that they're making today. Because as we all know from, you know, understanding what resilience isn't just taking a punch. Resilience is absorbing the punch, learning from it, and then so that you're better moving forward. And so those are the types of questions that we're asking companies as they're thinking about, you know, continuing to navigate through this very difficult period.
And everyone has a plan until they get punched, as that famous American philosopher Mike Tyson once said. To your point, Michael, you know, with the SEC, first of all, we learned in 2020 that as Americans, we do everything uniquely and different from the rest of the world, right? And so we've entered ESG and have started of an embracement, and that will be a process. The SEC is a disclosure regime. In disclosure, sunlight, we all know the issue with that. But as I talk to boards, the disclosure, I feel, is a secondary action, which is, and I'll give an example here. The first primary action is what matter you disclose is something that you must think about, but primarily first is thinking about what data you need as managers and as boards to make decisions. Pay equity is one of those things. Whether you disclose it or not is a very big issue, and it requires a lot of different departments thinking through the value of that non-mandatory, or which is called voluntary, sorry about that legal phrase, voluntary disclosure. However, as a manager and a board, you got to know if you have a pay equity issue, which, by the way, it's you either have it or you don't. You know, you either have it or you don't. It's pretty straightforward. Whether you make that secondary decision to disclose is a completely different thing, but you got to get that information. And that's what's happening now, sort of prompting that discussion from boards, which is, okay, but do we have this information? We can talk about whether we should disclose it, which is probably not, or sort of figure out how we could talk about it, but we should know, because then we're not doing our jobs and managing this very important issue.
That's great. That's super helpful. So we're bumping up on time. So Nandika, I'm going to give you the last question. So for the past 20 years, CECP has really been that trusted advisor to the corporate leaders of the corporate foundation, corporate responsibility teams, and sustainability teams. So as a former practitioner yourself, can you share with your peers why and how you think the CEO Investor Forum Network is a CECP engagement opportunity that corporate leaders can lever to help link their ESG initiatives to their company's financial performance?
Yeah, no, of course. And we are extremely grateful for the support we've had of our more than 250 companies over the last 20 years. And as I think about how we are positioned at the CEO Investor Forum, and thank you, Stephen and Ray, for your endorsement of the work we do. I think we are here really to support and prepare corporate executives for the next generation of stakeholders, and a rapidly emerging purpose-driven economy that is no longer looking back, but looking ahead as to how we can collectively shift our focus from short-term performance to long-term value creation. And for the corporate leaders on the phone, you know, hopefully I'm not overstating the value we can bring to you, but we have experienced this in working with over 35 companies, large cap companies, and we've helped break down silos within companies. We've helped position corporate leaders provide them with the tools to wrap a coherent narrative around this expanded disclosure ecosystem. And we have built-in support to help you present a long-term vision that links corporate purpose, which is extremely important, and corporate responsibility to financial performance. And as we mentioned before, and we will share more details with you on some of the tools and products that we have in our pipeline, we know that businesses who have built resilient and sustainable models have less volatility and better financial performance over the long term. And we all know on this call that we are not going to undo 50 years of Milton Friedman's philosophy in 1 year or even 5 years, but we should be thinking about our future generation who should have access to economic and social systems that deliver equal access to healthcare, action on climate crisis, affordable housing, quality education, a living wage, and sustainable development. These are like the basics. And I very passionately feel that I think companies have the pulpit, they have the heft, they have the dollars to really make a change happen. And I'm very confident and optimistic about what the future looks like for us. And I want to thank Michael and Ray and Stephen for their time today and for a very interesting conversation. I know there were a number of questions in the chat. We will get back to you on those. And I want to thank you all for joining us. We appreciate the time. Please take a minute quickly to just share your thoughts on how we did, because this really helps us do better. And we look forward to connecting with you over the next couple of weeks. And thank you for joining us for our launch. Thank you.